In her last scheduled news conference before her term expires, Fed Chair Janet Yellen said a modest rate hike was appropriate given the strength of the job market and 2 quarters of solid economic growth.
Household spending has been expanding at a moderate rate, business investment has picked up, and favorable economic conditions abroad have supported exports. Overall, we continue to expect that the economy will expand at a moderate pace.
For consumers, that will mean higher borrowing costs.
Well, this is the 3rd rate hike of the year and the 5th total in the last 2 years since the Fed started to boost interest rates. And so the cumulative effect on consumers with credit cards and home equity lines of credit is starting to mount.
But a new survey by the National Association for Business Economists suggests the economy is ready for slightly higher interest rates, especially if the U.S. Congress succeeds in passing a tax reform bill.
We're still at extraordinarily low rates and historical standards, and it would probably be healthy to get that rate up a little bit more, particularly if we see a huge growth in the deficit as a result of the tax cut.
Analysts say the proposed Republican tax cuts will add to the deficit and debt, which could hurt the economy. But the cuts can also boost disposable income for most income groups and corporations.
It could, and the way the dominoes fall on that is if the tax bill provides some juice to the economy, revs up the economy, that could lead to higher inflation. Higher inflation would lead to a more aggressive Fed with regard to interest rates.
Low interest rates tend to increase prices, but that has not been the case since the Fed started slashing interest rates in 2009. Yellen expects inflation to move closer to the Fed's 2% target in the coming months. By then, a new Fed chair will be in charge, former Fed Governor Jerome Powell. Arcega for VOA News, Washington.